this is Anupriya Dobal from Resurgent India. In India, mutual funds are urging SEBI for a relaxation of the maturity norms for additional Tier 1 or AT-1 bonds, hoping to boost investment in these instruments. Let's unpack what's behind all this. AT-1 bonds are unsecured, perpetual and non-convertible bonds that banks issue to shore up their core capital base and meet the capital adequacy requirements under Basel III norms. Under the Basel III framework, banks' capital is divided into Tier 1 and Tier 2. Tier 1 capital is subdivided into equity capital and additional Tier 1 capital, while Tier 2 capital includes, among other things, subordinated debt with a minimum original maturity of 5 years. AT-1 bonds are subordinated debt instruments and form a part of Tier 1 capital. These bonds often come with a call option, allowing the banks to issue them to redeem the bonds after a set period. Created under Basel norms after the 2008 global financial crisis, they help banks raise capital without relying on government support. AT-1 bonds carry higher risk due to their equity-like features, allowing banks to absorb losses. In financial stress, banks can delay or reduce interest payments. Banks can even write off AT-1 bonds during severe financial distress. Unlike senior bond holders, AT-1 investors may rank lower or even lose payments, as seen in Credit Suisse collapse, where $17 billion of AT-1 bonds were wiped out. To offset these risks, banks offer higher interest rates on AT-1 bonds compared to other debt instruments. In India, the 2020 restructuring of Yes Bank led to the complete write-off of its AT-1 bonds worth 8,415 crore rupees, which caused significant losses for bondholders. Additionally, concerns over their volatility and lack of transparency have continually fueled ongoing debates in the financial world. Despite these risks, AT-1 bonds remain a key tool for banks globally, allowing them to raise capital without immediate repayment obligations. Last month, SEBI said that the valuation of Tier 1 bonds by mutual funds would be on a yield-to-call basis. This was a departure from the norms that it had introduced in March 2021, where it directed mutual funds to value these bonds as 100-year instruments. The yield-to-call method is used to calculate the potential return on a bond if it is called or repurchased by the issuer before its maturity date. It essentially estimates the yield an investor if the bond is held only until the call date or not until its full maturity. The current push to reduce the maturity period stems from the challenges that the 100-year valuation poses. Discussions are underway between mutual funds and the regulator, with the push to cut the maturity from 100 years down to closer to the call option period. The issuance of AT-1 bonds by banks has seen a decline, with financial year 24 figures showing a significant drop compared to previous years. Reducing the maturity period would potentially restore interest in these instruments, especially from the funds that are restricted from investing in these instruments on account of shorter duration mandates. Thanks for watching.